Hi, Professor Nicholas. Here's Victor Branco, and I'm gonna talk about the Express Spa Group company. So we know that the company was found in 2006, and their mission is to provide spa service to tourists at airports. And they divide the group in three business units, which is Express Spa, Express Test, and Treat. We know about the impact of COVID-19 on travel wellness industry. The sharp decline in air travel severely impact airport-based companies like Express Spa and too many other companies. It is also known that airport has barriers to entry, and this can create oligopolies, which means less competition and more profitability. And this type of market structure allows companies to create different value propositions with more flexible pricing strategies. Comparing Express Spa with other companies into the retail travel sector, we can see some key um, points that are different between them. So we can see that the cash ratio between Express Spa for Dufry it's very better than the selected company, and also the price to earnings ratio, which is better in comparison for Hudson. But in other side, when we see the gross profit margin and the return on invested capital, we can see that these ratios for Express Spa doesn't perform good as well. Regarding the WACC analysis, I start to look the book value of the equity and the debt from the balance sheet on from 2021, and then I use all those informations to calculate the WACC. And one special thing is for the beta estimation, I try to use a combination from three different beta markets. For the equity valuation calculation, I use the discount free cash flow method, and for that, I assume the growth rate as 2% for 5 years, and I could find the terminal value, the present value, the value of operations, and to reach the share price, the intrinsic share price of almost $4. My conclusions and recommendations for this assignment, it's I find that the ROE is less than the WACC, which means no economic profitability. The cost of capital is too high for the current business profitabilities, which means a bad thing. And I also see that the company has a good amount of cash in the bank, which means maybe they can use this cash to sustain the operation. And my recommendation is to company find other company to try to merge or to create a JV to share the structure costs because it's too high, or to uh, the company has to uh, make the business even smaller. And at last, my recommendation is to buy stocks of the company because the stock prices are low. The company has a good amount of cash, and they have low cost of debt, which means they can use debt to leverage the operation in the future.